So clients of KeyStone's U.S. Research should be familiar with Bowman. It's performed well after being recommended in the $18.84 range, and it's trading just under $40 today. It's up about 111%. What does Bowman do? Well, they are based in Reston, Virginia. They're a national engineering service company and program management firm. The company's core business involves delivering infrastructure, engineering, technical services, comprehensive project management solution to a diverse client base comprising owners and operators within the built environment. Its market cap about $689 million, trades just under $40. Like I said, doesn't pay a dividend. But what makes Bowman different from many construction or engineering firms? Their key differentiators, I would say, is no general contracting. Unlike many engineering firms, Bowman does not engage in general contracting or design build projects. This strategic decision allows them to help avoid the financial risks associated with construction delays, cost overruns, and liabilities for a project's physical completion. Their role is to provide the expert planning and design services, not to execute the construction itself. Service-based, low inventory model that kind of makes Bowman stand out. Their business is centered around providing intellectual and technical services. They don't carry significant equipment inventory or physical assets that could devalue or create financial risk. Their primary costs are internal labor and other professional expenses, which are more predictable and controllable than capital costs and variable expenses of a contracting firm. They are a growth by acquisition story, but they do also have organic growth. Their growth strategy is heavily based on acquiring other engineering firms and consulting firms. This allows them to quickly expand their geographic footprint, diversify their service offerings, and add new talent and clients without long-term high-risk capital investments of organic expansion. However, they're still growing, and even in the last quarter, out 8% organically. If they had zero organic growth, we'd be less attracted to the business. Their revenue is derived from four core areas. Building and infrastructure is by far the largest at 46% in Q2, consisting of 21% commercial, 17% residential. 22% is power and utilities and energy, consisting of traditional energy. That still makes up the most here in this category. Energy transition and renewables, and data centers, which are growing at present, the latter. 20% of the business is transportation, consists primarily of roads and bridge work, and 12% finally is natural resource and imaging. Let's look at the stock over the past month. Strong performance here, up almost 26%. We see over the last year, it is up, or so year to date, it's up around 60%. So what is driving the share price performance? Well, there's a number of things, but as with most businesses that we like, it starts with strong financial performance. We can see here, gross contract revenue is up 17% in the last quarter. Gross margin up 120 basis points. We can see net income. That is the real kicker here, up 386%. And on a per share basis, net income was up significantly. If you look at adjusted EPS, it came in at 56 cents per share from basically a loss in the same period of last year. Now, they also increased their guidance as well, and that is driving the share price higher, as we can see here. Now, it's not just this quarter that they've increased their guidance. We can see here there's a string of consecutive higher guides from the company, and that is driving the share price forward. Let's look at the rationale for the raised guidance. They have strong demand and bookings. The company is experiencing robust demand across its core verticals, particularly in transportation, renewables, and energy transmission. This demand is translated into record bookings during the second quarter, resulting in a book-to-bill ratio exceeding 1. Management has reported that bookings in the third quarter are already surpassing those of the second quarter. So, it's good to have a good core in the current quarter, but stock market is always looking forward. The fact that they're looking at bookings in the third quarter already surpassing those of a strong second quarter indicates some sustained momentum here. Record financial performance. you can see there. We talked about that in the quarter already. You looked at the numbers there. Operating leverage and margin expansion. The company is observing what we would call a scale effect, where revenues growth outpaces overhead and expansion. This is leading to margin improvement attributed to disciplined labor, cost management, and an optimized workforce and utilization in the workforce. There's diversification and organic growth. We talked about that, but Bowman continues to benefit from diversification of its revenue streams. Their revenues come from across their verticals, like we saw a number of different areas. Notably, transportation grew by 21%, natural resources and imaging grew by 19%, power and utilities and energy by 5%, and building infrastructure by 4%. So across the board, really, they're seeing growth. That healthy backlog, substantial, almost 25% growth in gross backlog in the quarter, provides significant visibility for the remainder of 2025 and into early 2026 at this point, underpinning future performance. You can see here, there is a compounding story in terms of their gross backlog growth over a significant period of time back to Q1 of 2021 here. It's compounded at an annual rate of 37%. So strong growth there. Let's look at the valuations. Well, the numbers right now look quite high. But if you recall the last quarter, the Q2 numbers that we talked about, they went from a loss position to a significant profit. We think that PE will move lower quickly. Again, in the last quarter, on a GAAP basis, they had 25 cents per share in Q2, earnings from a loss of 24 cents on a GAAP basis in that quarter. And the adjusted diluted were 55 cents, up from a loss of 3 cents. And those numbers significantly exceeded analyst estimates. So the estimates that we are looking at here are likely low right now and lagging the fact that the last quarter was strong, and they're guiding towards a stronger quarter coming up. The price to cash flow ratio on a trailing 12 months basis looks a little better. It's in the range of 20, not overtly high for a company with organic and acquisition growth. So the conclusion here, it's a quality business, well run, with a growing backlog, both organically and via acquisition. Valuations appear higher, but are quickly moving lower. Clients will be updated with our new rating over the next 10 days. And there is ownership here. That's the disclosures.
Yeah, I was just going to say that it's interesting how these engineering and construction service companies have really become so attractive to investors. And a lot of that being like the AI build out, and then the build out of the required energy infrastructure to power it all. And then, of course, there's just the infrastructure deficit in North America. So a lot of investment needed there, and some of it happening. So this is what's driving a lot of this growth in the engineering space, and overall higher valuations for the companies.
Yeah. And then data centers are a big driver. They're still, for Bowman, they're still smaller part of the business, but people, they're assigning a higher valuation to these companies that we've seen in years. So you do have to be careful. Will this continue going forward? We have to look back at historical numbers on many of these businesses, because some are trading at the upper end, significant or well beyond their historical multiples if you look at 5 years, and we'd be a little bit wary of that for businesses that have never traded really consistently at those type of multiples.